The premise of this building of a portfolio is that metals are not one thing. And if you're here at this event, I'm sure you're aware of this, but it's really important to put that into action. Not just be aware that gold moves differently than copper, moves differently than uranium, moves differently than lithium, but to actually structure your portfolio around that, or at least structure your expectations for the stocks in your portfolio around that. So I just threw together a 5-year chart of uranium, copper, and gold. There's some correlation in those prices, but there's also a lot of discord in those prices and how they move. And that all of those moves are made sense for particular reasons at particular times. So metals and mining stocks, or metals are not one thing, and metals projects are not one thing. Different projects, different project stages make for different investment theses. So you really have to meld those two concepts together. What is the metal doing? What's the project stage? What's the market up to? What's the investor sentiment? And that, I think, is really important in creating a portfolio where you have reasonable expectations for when things are likely to perform within that portfolio. So that's it. What metals do you believe in, and on what time frames? Because this determines what kinds of stocks to buy within each of those. So I'll go through some of the metals, and then I'll talk about which stocks, therefore, I am buying for each of those metals based on what I think is happening or going to happen with those metals. So gold has done a very impressive job over the last few years, even if that impressive job has made for a very boring share price chart, or a very boring price chart, right? Nobody gets excited about a sideways chart. And we've had a very sideways gold chart for quite a few years. Obviously, the big change is that now we are in a heading towards rate cuts environment. Absolutely fundamentally different for gold, that we are heading towards rate cuts. That gold managed to hold its ground despite all of the rate hikes is the thing that stands out so much. So now we have rate cuts coming. We still have all the central bank buying that was the reason gold held its ground so well. And the chart is bullish. All of those things add up and make me very opportunistic on gold. But I don't think it's going to happen tomorrow, because I think the next leg up will probably require market confidence in the time, like that the next rate cut is right actually here. And we kind of thought that it was, and now guess what? Traders are stepping those bets back a little bit. Fair enough. I don't know if the Fed is actually going to cut in March. Anyways, I think we have to wait for that, the certainty of the cut and the timing, and that will when that happens, whether through economic data that's weak enough that it gives people confidence that the Fed's going to be like, okay, now we have reason, we can do it, or whether it's just they want to get the cuts in before we get too close to the presidential election. Once there's news that the rate cut is coming, I think gold will make its leg higher. But since we don't know exactly when that's going to happen, the more cautious approach, rather than diving across the spectrum into gold stocks right now, is potentially to buy the ones that move first and most when gold makes its move. Because if gold breaks up through $2,100, it could go above. It could go nicely above that, right? Because that's a significant ceiling. So you can definitely own the stocks that move first and most when gold makes a big move like that. The producers, the building or close to building big new mines. Those are very rare assets these days after the doldrums that we've been in. And then you just have your list of explorers ready. And as soon as the market starts to go, then you can deploy into them. But it is a bit tough to deploy into them now and then be like, okay, is it next month? Is it 6 months from now? If we all had unlimited capital, then sure, buy them now. They're super cheap. But I am just being a little bit aware that we don't all have unlimited capital. And so I think it's just important to be aware that it might not happen tomorrow. I think gold will make a big move this year, but it might take a few months yet before that plays out. Copper is a yes, in that the market will happen, and it will happen because we've had over a decade of very conservative management teams at major copper mining companies, at all major mining companies, disinterested markets, and ever harder permitting. And those three factors have pulled together to mean we haven't been building new copper mines. It's a really significant thing. We also haven't been finding big new copper deposits or pushing them towards development. And so, there's two charts here. One's supply demand, one's current reserves, I believe, in major discoveries. You can see that that's clearly trending down as you move through the decades. And I saw a really cool compilation of the top 40 copper development projects in the world, just a table over the holidays. And I loved the quote that came along with that, which is that 31 of those 40 are facing significant challenges. And if I limited that down to projects that could produce within 10 years, so pre-feasibility or feasibility stage projects, there were 23, 9 of them were blocked, not going anywhere. At this point, just take them off the list. And another 5 faced very significant permitting risk. So 14 of 23 were like, don't place too many bets on those. That's just a capture of the amount of challenge there is in bringing that copper supply on. But it's not going to happen tomorrow or probably the day after. And my basis for the fundamental argument here is that investors buy commodities, in particular copper, which is the PhD of growth, right? When that's what they're positioning for, when they're positioning for global growth. They also will buy it when the supply gap is here and people can't buy copper today. That's what's moving uranium, right? Uranium's also a commodity. Nominally, it moves when people are positioning for growth, but oops, we ran out of uranium, so we better start investing in that now. I don't think we're going to get to that for copper tomorrow. I don't think we are going to get to a position where where the broad market is positioning for growth or where people have trouble buying copper. Maybe not even this year. I said uranium worked through its slosh, its excess supply for 6 years. Copper's been working through its excess supply for a couple years already. But remember how many warehouses of copper there were that the Chinese were leveraging to have money in the housing market? That's the kind of excess supply that is working its way through the copper market. So we're not there yet. It's going to be a great market when it happens, but I don't know when that's going to be.
Quick break here, guys. Today's episode is brought to you by Coppernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Coppernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galliano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and VRIC on his board at Coppernico Metals. Check out coppernicometals.com. Now back to the interview.
Silver is a very similar argument to copper. I think of silver primarily as an industrial commodity, and we had a really significant deficit. It's always a tight market, often in deficit. The deficit's usually met with recycling. We had a much larger deficit than usual the last 3 years because of increased solar demand. Interestingly, you can hardly recycle anything from solar panels, so the recycling factor of copper that's consumed keeps falling because solar keeps growing and we can't get the silver back out of that. The other way that we managed the deficit in the past few years was dishoarding. ETFs and investors were just selling back their silver, but that pool doesn't last forever. It's kind of like that copper situation, right? We're working through the excess. And kind of like copper, we're not in a growth situation. COVID, recession, it diminished that focus on silver because it is really an industrial metal at this point. But when we return to growth, I think that focus will come right back and it will shine because copper sort of has that, or silver sort of has that appeal. So I think that has a very similar outlook, thought process, timeline as copper. Lithium's an interesting one, right? So looking back on this crazy price chart, in 2021 and 2022, the lithium price soared 700%. And that was because Chinese electric vehicle sales boomed. There were amazing subsidies, and so there was a huge surge in Chinese electric vehicle sales. Then in 2023, China did not renew those subsidies. And all of a sudden, a price that had gone too high was given a reason to correct. And correct it did, and it came all the way back down to where it had been prior, right? The interesting thing is that the chart on the bottom there that I borrowed from Marin shows that Chinese electric vehicle sales are at all-time highs. So the reason that it happened in the first place is still happening. And now America is now doing the push. The official US target for electric vehicles is to increase market share from 5% to 50% by 2030. Crazy target. Lots of reasons that that's very, very unlikely, but nonetheless, that's the target. That's the push. That's the goal, right? And the subsidies for US electric vehicles say no Chinese lithium. If we were to get to 50%, market share by 2030 and not include Chinese lithium, American production would have to increase 40-fold. I'm not saying that American production is going to increase 40-fold in the next 6 years, but I'm saying that the official targets are trying to push us in that kind of direction in terms of a scale of ramp up. So I think those growth metals, you don't necessarily need to have exposure to them today. There can be corporate reasons, stock-specific reasons, absolutely, that's different. But I think they're more of a global growth argument. And when we start to feel that investors are like, okay, we got through the storm, we're on the other side, we want to start positioning for growth, I think those are going to be three markets that are very worth positioning in. And just like I said with gold, you can start with the sort of the stocks that move first and most when a market goes, the producers, the big advanced assets, and then you can move down. This is just examples of what happened to the big copper producers, the biggest ones in the last copper market, right? 10x in the biggest copper miners. So when it happens, it can happen in a great way. Now, I just went through all this timing and patterns and leverage and outlook and all of that. And then there's the exception to the rule, which is explorers. Because discoveries can move a stock in a phenomenal way in any market, right? So if you are someone who plays the exploration side of the game, throw everything that I just said out the window and you can buy the stock based on corporate reasons, right? What you think the investment thesis is for that stock. This is something that I talk about a lot in my newsletter. I own a lot of explorers and I explain what my thesis is for each. And then I reassess that thesis every time there is a news release because it's likely to impact that thesis.